US markets closed higher on Wednesday after disappointing retail sales and trade war uncertainty raised speculation of a dovish move from the Fed. Markets are now pricing in a roughly 75% chance of a rate cut this year. Bryan Noble joins me now from tradernoble.com to discuss some of his technical insights. Now, Bryan, last week was a bit of a bloodbath on Wall Street. It was the worst week of the year. We are seeing a little bit of a pullback yesterday, and indeed today we're up by around 0.25% on the US 500. That's the S&P 500. Tell us about some of your technical insights when it comes to the equity market stateside.
Yeah, well, the S&P is still a buy and dips in my opinion. If you look at yesterday, the market was in meltdown after the retail sales number. We got down to 28.15, made a lower low than we had made on Tuesday, and yet the market reversed higher, ended up being a key day reversal. We need to really take out this 28.60, 65 areas where the 50-day moving average. If we can break back above that, then we should go back and test the 2900. You know, it's really a game between America and China on the whole trade agreement. We all know there's going to be some sort of an agreement that's going to be fudged at the end, because the ramifications of no deal are just too great, and the stock market told us that last week with the sell-off.
So ultimately, does that mean a breakout to the upside?
Eventually. I still think, I have a target the S&P, I still think we'll hit 3,100 in or around that level before eventually the thing goes. We know the economy is slowing down, we can see it in the numbers, but at the end of the day, as long as the central banks continue to, take part in the markets and try to support the markets, it's extremely difficult to be short, as we saw what happened at Christmas when they just come in and bought the market.
All right, let's switch to the Dow now. Obviously, similar price action to the S&P. You mentioned earlier about the significance of this 50-day moving average line. Tell our audience a bit more about what that means for the price action.
Yeah, well, there was two key levels for the Dow. You've got the 50-day moving average and the 200-day moving average. When the S&P made its high back on the 1st of May at 29.55, the Dow did not break its last year's October high. So that was what I call negative divergence. So that was the first warning sign. Obviously, when the Dow broke the 50-day moving average first, the S&P and the Nasdaq subsequently followed suit. Then we went down and tested a 200-day moving average, and this is a bit of I know you got a red line there. It was a bit of a red carrot with the 200-day.
Because we did very briefly break below, didn't we?
Yeah, but it tends to be a false break. They really need to break for 3 or 4 days before you can say it's a confirmed break, because a lot of technical analysts get all excited when they break it to 200-day, and that's why we saw an acceleration a couple of times. But yet when we closed below there on Tuesday, we broke back above it we closed below there on Monday, broke back above it again on Tuesday, tested it and broke below it yesterday afternoon, and when the American markets opened, and then we had this big reversal and closed back above it again. So the other thing you got to keep an eye on is the VIX, the volatility index. When we're above 20, a lot of hedge funds are not allowed to trade the stock market. It's part of their criteria. So the 20 is a key level. We bottomed at 12 on the 1st of April, had a closing high of just over 20 on Monday, and we're back closing last night in the 16s. So the VIX, if you're watching the price action, and if the VIX is going up and the stock market is going down small, but not really going down that much, you got to be really careful. So the VIX to me is a key for this market going forward. But ultimately, as long as the Dow can hold this kind of 25,200 to 25,400, I think we should go back and test the 26,000 area again.
What about your targets heading into later in the year?
Again, depending on that 25.2 to 25.4, I think against the 50-day moving average, I will be a short-term seller around 25,800 to 26,000 with a 150-point stop. I think given the two-way volatility we've seen over the last few weeks, if you look at last Friday, I happened to be in Malaysia, and with the 7-hour time difference, I went to bed. The S&P was trading at 38. When I woke up on Saturday morning, it closed at 85. Anybody who was long and didn't get out on Friday night got killed with the weekend tweets from Trump, and the market opens at 55, 30 points lower on the Sunday night. So it's dangerous having positions overnight. You really got to, it's day trading at the moment, but there's plenty of opportunities intraday to make good money.
It's certainly got to be careful of those Trump tweets, that's for sure. Let's move on to commodities, in particular gold. I mean, with all the uncertainty around the trade tensions, particularly this week, surely there must be a lot of investors that are looking for safe havens.
Yeah, well, it's interesting. Gold has actually performed where silver has totally underperformed. It's like a comatose in comparison. But as you can see on the chart there, we have a series of lower highs in gold. Gold really needs to take out 1325 and ultimately 1350 to get, I think, for the gold bulls to get really excited. On the downside, I think 1250 is very strong support. So I don't really see gold breaking below 1250. We're trading around the mid-90s, 1290s at the moment. Yeah, silver is near all-time lows. Silver's trading at 1480. Just can't get any bid to it at all. And in contrast to that, we've seen Bitcoin, which has gone up 11 days in a row to go from 3,000 up to over 8,000 before having a small sell-off this morning.
It's interesting that that's actually performed almost like a digital gold in the sense that it has kind of been a safe haven away from that trade war uncertainty in recent sessions, given the fact that we have seen such a sharp rally in Bitcoin that has coincided with the volatility in equities.
Yes, it's like people have changed their criteria. They're going into
exactly.
They're leaving the gold. And to be honest, like gold, I nearly get fed up reading about all the gold bulls, because in my 25 years of trading, all I read, 90% of the articles on gold is, you got to buy the market, got to buy the market. And yet it's been a difficult hold over the last couple of years.
So we have seen this series of lower lows and lower highs. What's it got to take for that pattern to be broken?
Well, as I said there, 1325 on the upside, and preferably 1350 on the downside. I think 1250 is a great buy. I think we should get a decent rally on any test at that level.
All right, let's have a look at the pound now, because it's really been struggling both against the euro. It's actually had its longest losing slide against the common currency since 2000, 9 days of losses, that's 5 days in a row. And it's hit a 3-month low as well against the US dollar. So not a great time for the pound. Do you see this as a buying opportunity?
Yeah, well, two things about currencies. Thank God for sterling, because there's nothing going on in any of the other currency markets. I mean, volatility is at a 5.5-year low against the dollar and the euro. It's been 112. Practically the euro for the last 6 weeks. The dollar index has been at a 97 handle for the best part of the last 2 months. So at least for sterling and the political situation here, we're seeing a lot of two-way volatility. I think the break over the last couple of weeks is overdone. I think 128, 127.5, 128 is very good support. Ideally, I'd like to see cable break back above 130 and preferably 130.5. I think if we can get back over the 50-day moving average, then we should have a run back up to the highs at 134 again. And I think ultimately some sort of a deal will be agreed out of Europe, because again the ramifications of this staying in limbo for the next few months doesn't really play out.
All right, so you're saying that we should wait to get above 130, say, before we enter this long trade?
Well, I'd be a small buyer against 127.5. You could buy that with a 60-70 point stop. Ideally, if you want to be more conservative and wait, I think if cable can get back above sort of 130 or 130.5, I'd certainly be a buyer with a 70 point stop, because you'll be back above the main moving averages.
Bryan, thanks so much for your time.
Thanks, Victoria.
That was Bryan Noble from tradernoble.com. I'm Victoria Scholar, and thank you for watching IGTV.